Hi everyone and welcome to Persian Money channel. My name is Arash, a health and life insurance agent as well as an IRS enrolled agent. And in this video, I want to go over some of the myths surrounding the whole life insurance as well as other cash value carrying life insurance type. I'm gonna make this video as simple, transparent, and honest as much as I can. However, forgive me if there's some shortcomings. I will be making reference to some legal structures in this video. However, I'm not an attorney, so you're more than welcome to consult an attorney in relevance to those information. And for most parts as well, this video and information provided here are not legal advice or financial advice. They're just for entertainment purposes. So without further ado, let's dig into this, and I certainly advise you to watch till the very end because it would be definitely an investment worth of your time. Okay, so section 7702 of the Internal Revenue Code and other sections in the IRC, they do the bulk part of trying to make sense of the life insurance. According to Internal Revenue Code, life insurance is not an investment vehicle. It is basically a means of protecting you in case of an unforeseen event that happens to you, so your loved ones that you have chosen as your heir will be entitled to a death benefit that would help them pay for, the expenses that in your absence they would probably struggle to manage. So as far as the death benefit itself goes, for the most part and as a general rule, that death benefit payment is tax-free. You don't have to pay any taxes on that. However, there is if that death benefit was paid to you on installments basis or was delayed, and some interest was also added to it to supplement you for this shortcoming, that interest is taxable, but it's a very fractional amount, obviously, compared to the entire death benefit. Now, from the insurance aspect of the death benefit, you have to understand two things. The first one is that if you've accumulated cash value in your policy in excess of the death benefit, your beneficiary is not going to get that. They're just entitled to the death benefit that has been declared in the policy. The second thing has to do with the way that the insurance company may qualify you for that death benefit. So if the cause of the death was due to overdose of consumption of alcohol or drug abuse, that's one scenario that the insurance company may refuse to satisfy the death benefit claim. Or if there was a major calamity or a large scale event like a war or sometimes a pandemic, for instance, endemic, those are the scenarios that some insurance companies may refuse to satisfy the claim for the death benefit. There are insurance companies and there are ways to perhaps negotiate with them. Usually they would charge you more if they were to cover these events, but just that's another thing that you need to keep in mind. Something that insurance agents and life insurance companies want to present to prospect clients is that they are entitled to something called dividends, basically a return on their investment that they put into this whole life insurance. So the thing about this is that it's not in the IRS of the IRS is considered a dividend. The dividends that the life insurance company offers you, those are return of the premiums that you already contributed and paid into that life insurance. It's not a return on your investment. These are two totally different concepts. All these buzzwords that you may hear, confident talks that try to convince you and present life insurance as a vehicle for infinite banking, laser, things of this nature. I'm sorry to be the bearer of the bad news to you. For the most part, they don't deliver what they try to relate to you. So just be very cautious. So moving on, however, speaking of that, the dividend that I just told you, when the insurance company wants to pay you those dividends, what they call as dividends, if you choose to not receive them and keep them as a reallocation in your supposed investment, that money would be taxed by IRS. That's a scenario that IRS considers that return of premium that you chose refused to not to be distributed to you as a investment that you're making, and they will want to tax you on that, and you will receive a 1099 form from your insurance company that you used to put on your tax return. Alright, so let's also go over some other things that the insurance companies and some financial experts try to present to you when they talk about the life insurance. So one of the things that basically they try to tell you is that having to do with overfunding your whole life cash value, so you can maximize your return on your investment. Now, the thing about this is that under Section 7702 of the IRC, there is this thing called modified endowment contract. So what happens is that when these overfunding exceeds a certain threshold, and I'm not going to go into the the legal jargon, simple said, within that initial 7 years, typically, that's one of the tests that they use. If you exceed that funding limit, your life insurance is not treated anymore as a tax deferred vehicle, if you will. It's there's additional any additional return on those portions that you contribute to your life insurance, they're taxable. And if you're going to withdraw them, you will have to pay tax on them, whether you call it borrowing, that is, or withdrawing, however where you want to use it, aside from the interest that the life insurance company will charge you. Now, speaking of all these buzzwords and confident talk, oftentimes you are told that, hey, listen, those corporations are not dumb people. They use life insurance to store their assets. Obviously, there's a reason for it. And speaking of that, yes, there's a reason for that, and that's because not in all the states, but some states within the United States, up to, that is, on an unlimited basis, if the company files for bankruptcy and see creditors will come after his assets, either the complete amount or portion of that is not basically is protected against the creditors. So it serves as a vehicle of asset protection. It's not necessarily for any gain or so. It's merely for that purpose. However, I have to remind you here that not all states offer you. Some of the states have a very, very low protection on that amount, so be very cautious of that. The other way that the companies, including corporations and also employee-owned companies, can take advantage of the life insurance has to do with what's called key employee life insurance. So if the success of the business is attributed to a key employee who plays a critical role in that success, the company can take out a life insurance in the name of the key employee, and if that employee happens to pass away, the company can basically recover its loss, in this case being a human key employee. The other thing that they tell you is has to do with the CEOs of these companies, who are technically the employees of the company, or other rich people, that they tell you that, hey, listen, these rich people are taking advantage of this vehicle. Obviously they know better, and why shouldn't you? So the thing about this is that I will explain to you, it has three parts into it, and I will go over all three of them. The first part, yes, if you're so rich enough that your assets exceed, I'm going to round it up, it's about 11 million to 12 million, depending on the tax year. It fluctuates. That's the limit on the state, tax on the state, basically. And if that's how much money you have that you want to give to your loved ones, yes, it is a wise idea to put that money into a prepaid whole life insurance, so your loved ones, once they get that money, that would be tax-free to them. The other scenario that these rich people might appeals to them has to do with the spending down impact of qualification for Medicaid. So although in my opinion it's not really moral thing for those rich individuals to still trying to take advantage of the system, even though they're high earners, however, if they choose to go that direction, there is such a thing called irrevocable life insurance trust, that they can put their money into that account, and so long that it's prior to the 5-year look-back period that the state Medicaid agency uses to determine your eligibility, you may qualify for that. Now keep in mind that when you utilize this trust, that trust still is subject to trust filing a tax return. The third part has to do with the individual's asset protection, as creditors might come after them for filing for bankruptcy or so forth, and they want to avoid that, and they put their money into life insurance. So in the same manner as the corporations, yes, the individual can also do that, but then again, keep a cautious eye on this. The rules of the state ultimately have to say, and many states don't give you that protection that you're thinking. Now, speaking of that, if this is what your what is a benefit that you're looking after, IRAs offer individuals complete return protection against creditors. So if you have a individual retirement account through your employer or directly yourself, and I'm going to throw in another tip here for you, since you're lucky day. If you're a rich individual and you happen to have a business, you can also take advantage of what's it called, solo 401k, which typically there's a annual limit on IRAs for individuals, but for a solo 401k, because there's nobody else in the business, and if you're the only owner of the business, allows you to go beyond that discrimination legality and fund that as much as you want. So you can have the same protection with an IRA if that's what you're seeking, to avoid your money, your hard-earned money, being subject to any creditor in the case of insolvency or bankruptcy. That is some route that you can also go for. All along, remember that insurance companies are in the business of making money, of course, and that's fair game. It's just that what they claim to you as basically 7% or so of return, that is only on a fraction of the premiums that you contribute to your whole life insurance, for example. That is, if you want to look at it as a real and effective interest that you might be earning, it's really 2% after allocating to the entire premium, 2 to 3%, roughly speaking. Now, there are two things that I do want to mention as valuable advantages of life insurance. The first one has to do with the living benefits that also applies to term life insurance, and it's not just limited to cash value carrying life policies like whole life. And what is living benefits? Basically, you, the person who has taken out the life insurance, if something happens during your life that leads to terminal illness, a critical illness, or a chronic disease, you may be able to collect some portion of the death benefit of the contract while you're alive, and you can use it for any way you want it. It's not just limited to medical expenses necessarily. So the terminal illness, depending on the insurance company, is if someone is a doctor basically certifies the person as terminally ill, that is, his life is going to end anywhere from 12 months to 24 months. That time frame differs across the board depending on the life insurance company that you're working with. The critical illnesses has to do with cancer, for example, stroke, kidney failure, then again depending on the contract that you're having. However, the key element is that just falling for one of these diseases is not enough to qualify you. The critical illness has to lead to your loss of ability to return to your functionality. That is, you're not able to make money the way that you used to do. The other way is chronic illness, and then again, that's also across the board different depending on the insurance company that you work. But those are the features that you can take advantage of while you're alive, and is an attractive feature for the person himself or herself. The second thing that I do want to mention has to do with the guaranteedness of the funds that you're entitled to. So with life insurance, generally speaking, if the life insurance company goes insolvent for any reason, typically states have laws in place that require other state life insurance companies to come in and take on the liabilities and claims of that failed life insurance company, and therefore you're still able to take advantage of your death benefit. But then again, keep in mind that if that's the only reason you're looking for life insurance, you can also put your money in a saving account, and nowadays some of the saving accounts actually have a very high yield, about 4 to 5% even on a long-term basis, which is not really bad. Or you can also put your money under your pillow if that's what you like to do. So to wrap up the video, the purpose of the video is not to convince you against or for the life insurance. It's just to make you aware of what's out there, and understanding that not everything is a one-fit scenario for everybody. You need to educate yourself on what you're looking for and find what fits you the best. The other thing is to just go for the common rule and not to put all your eggs in one basket. Diversification is always a good rule of the thumb, and I personally do recommend people to get life insurance, especially term life, in an unforeseen event that may come upon them. There's also such a thing as whole life insurance that doesn't have that cash value feature added to it, and it's much more affordable, which makes it attractive for you. The last thing that I do want to mention is that the concept of insurance generally is about addressing the need of the people who are low earners. That is, the susceptible part of the society. I know that goes against the psychology, because if you're a low wage earner, you will probably look at any insurance expense that you're having as a unnecessary thing. But the reality is that if you have that kind of a limitation on your income, you really are the one who need insurance, whether it's health insurance, life insurance, or other insurances having to do with your car or liability. So that's also another thing to keep in mind. If you appreciated the honestly transparency information that I packed in this video, I would be happy to assist you. My contact information is in the details. Anything that has to do with taxes or health and life insurance, I'll be more than happy to assist you. Take care of yourself, and until next time.